Today we are going to discuss the final part, and this is about measuring what matters. We have talked about why revenue operations matters, what it is, the problems it serves, and how to build the function. Now we can talk about measurement. Because if you're going to invest in revenue operations, you need to know whether it's working, right? I've observed that most companies, they measure the wrong things. Let me start with what I see constantly. Executives, they create all these revenue ops dashboards that are essentially vanity metrics. Number of leads generated, pipeline created. Then they show activity metrics, dashboard count, system uptime. These tell you what is happening, but they don't tell you whether what is happening is good or bad. They don't tell you whether revenue operations is actually making the business more valuable. I've observed RevOps teams that can show they are very, very busy, but they have built 15 reports. They have integrated 5 systems. They have documented 20 processes, but the business outcomes have not improved. It might have stagnated and might have even gone down. The margins are still compressed. The forecast accuracy is still terrible. So in those situations, RevOps has become an activity center rather than a value center. So let's talk about what actually matters. I'm going to walk you through the metrics that separate high-performing revenue engines from those that just look busy. These are the metrics I look at first when I'm evaluating whether a company has mature revenue operations. Metric number 1, forecast accuracy. This is your North Star metric for RevOps effectiveness. Can you predict within 5% accuracy what you will close this quarter? What about next quarter? If you can, it means that your data is clean, your processes are consistent, your pipeline inspection is rigorous, and you understand your conversion dynamics. If you cannot, none of those things are going to hold true. I've observed that companies without strong RevOps, they typically forecast within plus or minus 15 to 25% of accuracy. Really bad. That's not a forecast, it's simply a guess at that point, with a little bit of math around it. And those guesses become very expensive because you miss your number, you have to explain it to the board, your valuation takes a hit. Or worse, you sandbag the forecast to be conservative, you beat it, but you left growth on the table because you did not invest aggressively in certain sectors that needed it. Companies with mature revenue ops, they consistently forecast within plus or minus 5% of accuracy. Some get it down to plus or minus 3% or 2%. And that's the difference between running a business and hoping you have a business. Here's an example of why this matters so much. I've worked with a company or with a friend who runs this company, and he asked me for some advice. And he showed that there was terrible forecasting inaccuracies. They were off by 20%, 30%. And the CEO and the CFO could not make confident decisions about hiring, spending, or strategic investments because they didn't know what revenue actually would materialize. They were perpetually in reactive mode. So they brought in a consultant. They implemented a proper RevOps discipline around the forecast. They started doing the deal inspection weekly. They created clear exit criteria for each pipeline stage. And they had very rigorous qualification standards, historical conversion analysis by deal characteristics, and this man was brilliant. And within 2 quarters, what he did was he improved the forecast accuracy to plus or minus 8%, which is remarkable, and within 4 quarters was down to plus or minus 4%. The business impact was dramatic. The CFO could commit to spending because she trusted the revenue projections. The CEO could make strategic bets on new initiatives because he knew what resources would be available. And the board, they gained confidence in management's ability to execute. So when the company's next funding round came to be, it was priced at a higher valuation because investors reward predictability. And that's what forecast accuracy is all about. It enables that predictability. It's not just a nice operational metric, it's fundamental to how you run the business and how investors value the business. Metric 2. Time to revenue and cash conversion. Most companies measure sales cycle time, fine. And the time from opportunity creation to closed one. That's useful, but it's incomplete. I'm personally more interested in the complete cycle from when a lead enters your system to when you actually recognize the revenue, and more importantly, when you collect the cash. Companies that obsess over sales cycle time, they have optimized it, but they have gotten it down to impressive numbers, vanity numbers. But when you measure time to revenue, it's a completely different story. You have long implementation cycles. You have delayed go lives. You have slow onboarding. You have extended payment terms. The deal closed fast, but you're not seeing the economic benefit for several months. Let me give you a concrete example. A B2B software company had a 47-day average sales cycle. Sales leadership was proud of this. They had really tightened up the sales process. But when RevOps measured the complete journey from lead to revenue recognition, it was 193 days. 193 days. Implementation took 90 days on average. Customer onboarding and configuration took another 45 days, and they had 30-day payment terms. The cash conversion cycle was over 6 months. Can you believe it? And why does it matter? Because when you're modeling growth and you're trying to forecast cash needs, you need to understand the real cycle, not the one that sales just gave you, a small, narrow sliver. The company was planning on hiring and spending based on closed deals, but the cash to fund that growth wasn't showing up for 6 months. They were perpetually undercapitalized because they didn't understand their actual time to cash. The RevOps helped them optimize the full cycle, but not just the sales piece. They streamlined implementation. They improved the onboarding process. They negotiated tighter payment terms with new customers. They got the end-to-end cycle down to 134 days, and then after that to 59 days. So from a CFO perspective, that is enormously valuable. So don't just measure sales cycle time, measure the time to revenue recognition, and more importantly, the time to cash collection, from the lead coming in to the cash collection. That is the thing that you have to look at, the entire cycle as a whole. Those are the metrics that impact your cash flow and your ability to fund growth efficiently. Metric 3, look at the revenue efficiency in the unit economics. This is where CFOs should pay particularly close attention to. What does it actually cost you to generate $1 of new ARR when you factor in all the real costs? Not just the obvious ones. Most companies, they calculate CAC by taking the sales and marketing and the expenditure on that and then divide by the new customers. That's a start, but it's incomplete. What about the discounting you give to close the deals? What about the professional services resources you have to throw at implementations? What about the goodwill that you have to invest for supporting customers? What about the customer success resources required in the first year to keep the customers from churning? What about the support costs for customers who are not a great fit? So I've observed some companies that thought that they had strong unit economics, but when you dig deeper, you discover they were actually unprofitable on some customer cohorts when you did the complete accounting of the system end to end. And this matters tremendously for CFOs making decisions about where to invest and how aggressively to grow. Here's what this looked like at one particular company. They calculated the CAC payback period, it was 14 months? And it seemed reasonable for their market, but when RevOps did the full analysis, including discount at close, the services costs, the elevated support costs in year one, the payback period was 23 months. 14 months is the official, 23 is what was observed. And that completely changed the investment calculus. At 14 months, you can grow very aggressively. At 23 months, you need to be much more thoughtful about capital allocation and efficiency. So the company had to make hard decisions based on this insight. They stopped pursuing certain customer segments where the payback period was even longer. They invested in product improvements that reduced implementation time and support needs. They trained their sales to discount less aggressively. And what happened? Over 18 months, they got the true CAC payback period down to 11 months. Still not the 14 months that they thought they had, but much better than 23. And they were making decisions based on reality rather than fiction. RevOps should own this analysis because it requires data from across the entire revenue cycle: marketing spend, sales cost, discounting patterns, implementation resources, support tickets, retention rates. No single functional leader has visibility to all of this, but RevOps does. The specific metrics within this category are things you look at, like CAC, the payback period, maybe the rule of 40 steps in, customer level profitability by cohort, the LTV to CAC ratio, those all come into gear. Track this religiously and understand them by customer segment, by deal size, by sales channel, and having that granular understanding is what enables strategic resource allocation. Metric 4, look at the cross-functional velocity and conversion rates. How efficiently does workflow through your revenue engine? How long does it take to move a lead from marketing to sales? How about from sales to customer success? From opportunity creation to legal approval to closed and won deal? And what percentage of leads and opportunities and customers make it through each transition successfully? Some companies with mature RevOps, they obsessively measure these transitions because that is where revenue dies. Marketing to sales, what percentage of qualified leads actually get worked by sales? What is the average time to first touch? If you look from sales to customer success, what percentage of closed deals have a clean handoff with complete information? What is the average time from close to onboarding kickoff? These metrics reveal the friction in your system. And friction, my friend, is very expensive. It slows growth, it wastes capacity, it creates poor customer experiences, and all of this hurt retention. I worked with a company where 47% of marketing qualified leads ever got touched by a salesperson. Only 47. Other 53% dropped out. Just never got work done. Marketing was not happy. They were spending money to generate leads. They had a budget, and the sales were ignoring it. And the sales said that the leads were low quality. There could be truth somewhere in between, but some leads are legitimately poor quality. And some leads, there might be timing issues. The prospect was not ready to buy right now, and sales had no process for nurturing them. And some leads, they just fell through the cracks due to poor process. So what did RevOps do at that point? They implemented lead routing automation, SLAs for follow-up time, a lead nurturing process for prospects who were not sales ready yet. The percentage of MQLs that got meaningful sales engagement went from 47% to almost 81%. The conversion rate from MQL to opportunity improved significantly because sales were focusing on better leads at better times, and marketing spend, the efficiency improved dramatically because less effort was being wasted. That is the value of measuring cross-functional velocity and conversion. You find the bottlenecks and the leaks, and you fix them systematically. Metric 5, look at the lead indicators and predictive metrics. This is where RevOps shifts from reporting what happened to predicting what will happen. Can you look at your pipeline today? And can you confidently predict what you will close 2 quarters from now? Can you look at customer health scores and predict which customers are at risk of churning 6 months before their renewal? Some companies are very good at lagging indicators. They can tell you what happened last quarter or the year before. That's great. But they are much weaker at leading indicators telling you what will happen next quarter or the next couple of quarters. And for strategic planning purposes, the leading indicators are far more valuable. RevOps should build models that predict future outcomes based on current indicators. Pipeline coverage ratios adjusted for historical conversion rates by stage, by rep, by segment. Customer health scores that predict the renewal risks. Look at the leading indicators of expansion opportunity that is based on product usage and engagement patterns. Companies that have built a sophisticated customer health scoring model, what do? They incorporate product usage data. They look at the support ticket volume. They look at executive engagement and a bunch of other signals. And that model then could predict with 85% accuracy which customers would churn at renewal 6 months before the renewal date. The value was not just in predicting churn, it was in having 6 months to intervene. Customer success could prioritize their attention on at-risk accounts. Product could investigate why certain usage patterns predict churn. Sales then have a more intuitive, deeper understanding which customer characteristics led for higher churn rates. Predictive analytics enables you to see things a lot ahead of the future, obviously, and you see problems coming far enough in advance to actually do something about them. You're not constantly in reactive mode. You're managing the business proactively. And the most important metric, I think, is the speed and quality of decision making. This is harder to quantify, but it might be the most important indicator of whether RevOps is working. Are your executive team meetings becoming more productive? Do you spend less time arguing about whose data is right and more time discussing about what to do about what the data is telling you? Can you model scenarios quickly and confidently? Do your strategic decisions or rather, do strategic decisions get made faster because you have the data to support them? I've observed that companies with mature RevOps, they make decisions faster with more confidence and better quality. They can answer questions like, what happens if we increase the marketing spend by 30%? What if we shift from transaction level sales to enterprise sales? What if we raise prices by 15%? What if we stop pursuing this particular customer segment and pursuing the other one? These are not wild guesses anymore. They are projections based on integrated data and a deeper understanding of conversion dynamics. Compare that to companies without strong RevOps, where these questions lead to week-long analysis and conflicting recommendations. And ultimately, the decisions are more intuitive. They're based on gut because nobody trusts the data enough to bet on it. So let me tie all of this information with a final observation. Revenue operations is not successful when it produces more reports. It's successful when it produces better decisions faster. When your forecast is reliable enough that you can plan confidently and your unit economics is well understood, then all of a sudden you're building that infrastructure, a very strong infrastructure. Your leading indicators give you enough early warning to be proactive rather than reactive. And your executive team is now they're operating from a shared understanding of reality rather than competing versions of the truth. And that's the difference between running a revenue engine and hoping you have one. I have observed companies with mature revenue operations grow faster, yes, but more importantly, they grow more efficiently and more predictably. They can model their growth and they can execute against that model. They can tell investors with high level of confidence what the next 4 quarters, 6 quarters will look like. They can make strategic bets knowing what resources will be available and what outcomes will follow likely from that. And from a CFO, CEO perspective, that predictability, that efficiency is what makes companies valuable. Because investors, they will pay premiums for businesses they understand and can model with confidence. They discount businesses where growth feels chaotic and unpredictable. Revenue operations is an infrastructure that creates that predictability. It's not overhead. It's not bureaucracy. It's a nervous system that lets your revenue engine operate as one coordinated system rather than a collection of competing functions. If you take one thing away from this entire series, let it be this. Revenue operations is strategic infrastructure. It is fundamental to scaling a business. It's fundamental to your product and your people. And the companies that build it right and at the right time,